to another video from Creativo Solutions. You're watching the Finance for Non-Financial Managers video series. If you have any comments or questions, feel free to post them below and consider subscribing to this channel so you'll be the first to know when new videos are uploaded. Visit the website for more content and resources to help, and follow us on Instagram and Twitter, and keep watching the YouTube channel for more support. So far, we've established what the financial markets are. In a previous video, we spoke about the financial market and we also expanded on the primary market. So to recap, we know that the primary market is when large companies list for the first time on an exchange. So if we're looking at the New York Stock Exchange, we would be focusing on American companies that would be listing their shares on that particular exchange for the first time. We know a financial market is a meeting place for buyers and sellers. So the sellers would be the company wanting to raise capital in the form of selling shares, and the buyers would be the public or other institutions or businesses that want to purchase those shares as an investment. Always remember that the financial markets are important for businesses in order to access more capital. We know businesses need capital in order to grow and expand. So when dealing with the secondary market, we're going to be focusing on the active buying and selling of those issued securities. So the shares that have already been issued in the market would then be bought and sold between other investors seeking a return. So the secondary market would be the actual New York Stock Exchange when other buyers and sellers are exchanging those assets. So we're looking at the trading of equity on those particular platforms. So that's the secondary market. The secondary market is where investors are going to be buying and selling those securities, which are the shares that have been issued previously by those large companies. So when a company first lists on an exchange, that's considered an initial public offering, and you would approach the primary market in order to do that. Once those shares have been listed and they're actively traded on an exchange, we would then consider that as being the secondary market, where those investors in other businesses or companies or organizations would then be actively buying and selling those issued securities. So always remember, primary is the first time you do something, so the first time we list, and the secondary would be after we've listed, once those securities have been issued. Always remember, the main goal is to provide businesses, i.e. the companies, with financial products. So they would be able to access those products to meet their requirements. It could be an investor wanting to look for return. It could be a pension fund looking at investing in specific assets for the portfolio. And the market is where they're going to access these products. A marketplace is just a meeting place for buyers and sellers, and therefore the financial market offers these products for the actual businesses that are considering buying them or selling them. So we've established what the secondary market is. We now need to consider, why is the secondary market so important from a financial management point of view? Well, financial managers are going to be making decisions. They're going to be taking limited resources and allocating those resources to specific areas in the business or external to the business, and they're hoping for a return in order to maximize value for their shareholders. So the secondary market offers opportunity for those businesses to invest or for those businesses to raise capital. The main reason why we'll be looking at the market is for accessing more capital. That's the key. We need to access more capital so we can then continue to grow the business. Capital is limited, but should we have access to markets around the world, international or local, depending on where we've listed, we would then be able to raise a lot more capital, and businesses with more capital would definitely be able to grow and continue to expand their operations. We know the secondary market is referring to the active buying and selling of securities. We need to understand what that means from a contextual point of view, because those securities are on a specific exchange. So the example we have here is the New York Stock Exchange. If we're looking at that as being the marketplace, those shares that have been listed on that particular exchange would have to meet certain requirements from a regulation point of view. So those listed products that we have in the market are regulated, and regulation adds a level of oversight in order to make sure that the market is fair and there aren't any unscrupulous transactions. So financial products are going to be actively traded, and if we're focusing on an exchange, the price will be determined by the market. So how many buyers and sellers we have will determine the price of that equity which is in the market. So for example, if we're considering one of the large American companies, previously we looked at Facebook and Twitter as an example of two companies that are focusing on generating value. If I'm focusing on Facebook and Twitter, well, then we would say that those shares for those companies would be listed on an exchange because they're public companies, and the market would determine what the current share price is for those assets. So if investors are wanting to invest in Facebook or Twitter or any other American company that's regulated and listed on an exchange, meaning they're public companies, we'd be able to access that information through the New York Stock Exchange. So any exchange around the world will provide you with information regarding those public companies that are trying to raise capital by listing their shares on that particular exchange. So the market determines the prices, and that's part of the efficient market hypothesis. When dealing with the market, we can trust that the current share price would be a true reflection of all the information in the market that would either be in favor of that particular company or out of favor, but the market will determine the price, and the price of those listed instruments will be quoted on the actual exchange. So investors or financial managers seeking different assets as a way to increase value for their shareholders may consider taking those limited resources that they have and choosing to invest that in particular products on that exchange. And that would be a way to help maximize wealth for that particular organization. This concludes this video. Thank you for watching, and please consider subscribing, and if you have any comments, please post them below, and consider liking the video, and we'll keep creating more to help you.